Thoughts on the silver squeeze?
Yeah, yeah. Nice try. It's certainly easier to squeeze the shorts in GameStop than the shorts in silver. I mean, it's a much, much bigger market, and you're up against a lot, bigger players there. Unfortunately, some people got some bad fills because there was one day we had silver up a couple of bucks. And in fact, we had so many orders at Schiff Gold on Sunday night that the people that ended up buying, paid these high premiums because we had to pay more to get the product because there was such high demand. And, the sellers, they see everybody lining up to buy. They're not idiots. They just raise their prices, right? So that's what's happening. You see a lot of this stuff, like they jumped on the pot stocks, and all of a sudden these guys rush in and these stocks, Tilray was up like 50%, 100% one day, then crashes the next day. That's the problem. These guys on Reddit, they don't know what a limit order is, I guess. They just buy at the market. I mean, these guys are getting raped. They don't know what they're doing. That is the problem. I mean, so you have to be a little patient. I even mentioned on my podcast, hey, okay, I can see a case for some of these pot stocks, but you can't buy them when they are up 50% on the open. I mean, you're just asking for trouble. You got to wait for a big dip. You got to look at some trend line or something and then buy it. You can't just rush in and be at the mercy of these traders who just see this gift horse opportunity to enrich themselves because they're really playing against amateurs, right? And you're a professional. It's like, go to a poker game and try to beat these pros. If you just play once in a while with your buddies and you think you're going to beat people that do it for a living, they don't do it for a living because they're bad players. They do it. You can only make a living playing poker if you're good at it.
Yeah.
And so this is what happens with, the amateur traders. They come in and the professionals eat their lunch. But look, as soon as I heard about this, the short squeeze, I immediately drew the analogy to silver and gold. I mean, I talked about it on my podcast before they even did it. It was like the day after I discussed it. Because, there is a big short position in the metals markets. In particular, if you look at the paper markets, the futures markets, where nobody has the silver. I mean, you do have some hedgers out there. There are some mines that actually have silver to deliver and that, may sell it forward to kind of hedge their costs and then they can deliver silver into their contracts. But most people who are short silver, they don't have any silver. They have no expectation of ever delivering silver because they know that the guy that's buying the silver doesn't want it either because he probably doesn't have any place to put it. So you have a lot of people that are gambling on what the price of silver is going to do, and they do it with futures contracts. But, I've always thought that one of these days, a number of the longs who have these silver futures are going to decide that they actually want the silver now, that they want to take delivery of the contract. And what they end up doing is they'll pay the balance because a lot of times when you trade, you don't put up the full value of the contract. Right, each silver contract is 5,000 ounces, and maybe only put up enough to cover 500 ounces. I'm not really sure the margins, but in order to take delivery, you got to pay for all the silver that's going to be delivered. But let's say a bunch of people who have these contracts who normally just roll them over to another month, and there's never any silver being delivered. They either settle in cash, or if they want to stay long, they just roll over to another month. And those contracts expire. But let's say some of these guys, they want the silver, which they're entitled to. Everybody who's long silver in a futures contract, you have a right to demand delivery. It's your silver. And so now the short, because for everybody who's long, somebody is on the other side of that contract short. And everybody who's short silver is obligated to deliver it if they are notified that they need to deliver. And well, what happens if you get the notice that you got to deliver? Well, shit, what are you going to do if you don't have any? Now you got to try to buy it. Well, what happens if there's a shortage of actual silver? All of a sudden, a bunch of people that were trading paper silver need real bars of silver to deliver. Good luck finding them. The price goes through the roof. In fact, what might happen as people start to realize that if they hold on to their contract long enough, they're going to have to take delivery. You're going to have a rush of shorts trying to cover their contract before they get hit with the delivery notice. And then the contract soars because people don't want to get stuck delivering silver they don't have. So that mother of all short squeezes, I think it's coming. it may actually bankrupt the COMEX. I mean, who knows? I mean, the people may want to get their silver, but they may not actually get it, because if the counterparty can't find it to deliver, well, even though you're entitled to it, you may not get it. That's why I tell people, if you really want your silver, buy it now. Take delivery now while it's there. Because in these derivatives, you may not actually get any silver. You may just get cash. And you may not want that cash when the price of silver and gold are skyrocketing.
Right now, I think you have an incredible opportunity in silver. In fact, if you've missed out on a lot of the gold rally, one way to catch up is by focusing now on the price of silver. In fact, as good as the gold chart looks, the silver chart looks even better, particularly if you view the market in relationship to its 2011 peak. If you look at gold, for gold to get back to where it was at its high point last year, it needs about a 7% rally. Silver rather, needs almost, I think, a 47% rally to get back to the high from 2011. That's an extra 40% that you could pick up potentially in silver. And I would be very hard for me to believe that you can see a new high in gold without a new high in silver. And since I believe gold is going to make a new high, I think silver is going to make a new high too. And therefore, if both metals make a new high, there is much more percentage gain in silver versus gold. Also, historically, you can look at the relationship, the ratio between the price of gold and the price of silver. Over the last 25 years, that ratio has averaged about 45%. Right now, it's 52%. So in order for the gold to silver ratio to get back to its 25-year average, you need a 20% rise in the price of silver without the price of gold going anywhere. Of course, since I think the price of gold is going to rise, the price of silver would have to rise that much faster to get back to its 25-year norm. But even the past 25 years have not been the real norm. Go back to the 19th century, when gold and silver still circulated as money in the United States. The average for that century was a ratio of 16 to 1. Think about where silver would have to be to get back to 16 to 1. In fact, I think at one point in 1980, the ratio got to about 13 to 1. In order to get to that peak, you're looking at silver, I think, at maybe $135 an ounce, assuming the price of gold doesn't go any higher. It stays where it is. Now, I don't know that we're going to get that ratio again. Remember, that was when the Hunt brothers tried to corner the market for silver, so that might be an aberration. Who knows? Maybe that's going to be the high point that silver will ever get relative to gold. But you never know. Maybe it'll retest it. But even if it doesn't retest it, it should approach it. It shouldn't stay down around 52 to 1. In a real bear market, well, maybe you'd see the gold to silver ratio move against silver in favor of gold. But if you anticipate a bull market, and of course, we've been in a bull market for 12 years, and I think that bull market has a long way to run, especially since Ben Bernanke has promised to print money until it produces a vibrant economy and more jobs. Now, since I know that not only will money printing not grow the economy and create jobs, it will actually inhibit both. Because the Fed is printing money, we're not going to get real economic growth, and it's going to be harder to create jobs. We're going to print money not until the economy, or not until the problems in the economy are solved. We're going to print money until the economy collapses. That's really what he's going to do. He's going to print money until he can't do it anymore, because a crisis takes away that potential. That's all that's going to happen. So what you need to know is that this bull market is ongoing. And if it is ongoing, history would say that silver has much further to go than gold. Not that I'm saying only buy silver, but if you've only been buying gold, this is an opportunity to buy silver. And in fact, maybe now you buy a little bit more silver than you otherwise would have bought, given the short-term upside in silver and the way it outweighs the short-term upside potential in gold. That is why we're doing actually a promotion at Euro Pacific Metals.